We appreciate all of the guests who have appeared on our show and sincerely thank them for providing you, our audience, with useful information. However, the advice our guests provide is theirs, and we encourage you to seek out a professional if you have specific questions about any topic we cover on the Crushing Debt podcast. On this week's episode of the Crushing Debt podcast, Credit Coaching by Kristi.
Welcome to the Crushing Debt Podcast with your host, Florida attorney Sean Yesner, where our goal is to help you get rid of the financial bullies in your life.
So welcome back to this week's episode of the Crushing Debt Podcast. My name is Sean Yesner, owner and founder of Yesner Law, and I have a real treat for everybody on this week's episode. But before I get there, I want to talk about our sponsor, Sam Cohen. He is the owner of Attorneys First Insurance. They write malpractice insurance for attorneys and title companies, both inside the state of Florida. And if you're outside the state of Florida, either he can write your insurance or he can find an agent that can write your insurance. He does an apples to apples comparison. He's very knowledgeable, very experienced. He'll tell you that your insurance is good and he can't help you, or he can compare apples to apples so you can see what he can offer versus what you have now. So if you are an attorney or title company and you have questions, your errors and omissions policy, your E&O, your malpractice is coming up for renewal, you can contact him at sam@attorneysfirst.com or www.attorneysfirst.com. The other thing I want to promote again is my new book, Become Debt Free in Less Than an Hour. And a lot of the topics may align with what we're going to talk about in today's episode. But again, you can get a free copy of that book digitally on seanmyesner.com/become debt free. So if you want a free copy of that book, seanmyesner.com/become debt free. But now that I've got all of that, I do want to get to my guest this week. So she's been a mortgage loan officer for more than 10 years. She was actually a short sale negotiator for me in another lifetime. She's a credit specialist. She's seen thousands of credit reports and helped hundreds of families obtain their dreams of home ownership. Her passion is to teach and guide about the foundations of credit, because credit is vitally important to have and to protect. So my guest this week is Kristi Nowrouzi. Welcome, Kristi.
Thank you, Sean. Such a pleasure to be here with you and reconnected again.
Yeah, it seems like a lifetime ago that we were working together, but I'm happy to reconnect. So thank you.
Yes. Awesome. Thank you.
So I do want to promote, if you have questions, we're going to be talking all about credit today, but if you have questions for Kristi, you can reach out at questions@creditkristi.com, and Kristi is Kristi. So questions@creditkristi.com. She's also got her own podcast, which I think this is going to be an episode of her show as well, and that's Credit Coaching by Kristi, and that's on all the major podcast players, just like Crushing Debt. You can get it on Apple, you can get it on Spotify, you can if you're listening to this, wherever you're listening to this episode, search for Credit Coaching by Kristi, again with a K, and you can find her podcast. But gosh, it seems like a lifetime ago we were in the heyday of negotiating short sales, doesn't it?
Hundreds and hundreds and hundreds of families we got to serve that way. And, nobody wants to wind up in a situation like that. Nobody goes to buy a house to have to short sale it or modify a loan, or even unfortunately, some of them wound up in foreclosure, right? Some just couldn't be saved. Some lenders didn't want to play. So yeah, it feels like a lifetime ago. 11 or 12 years ago.
Yeah.
But yeah, so we see them, we see people at all stages of life and in all walks of life, wherever we are, that's where we are. So so where would you like to start, Sean? This is exciting.
Well, so one of the things that I like to get into right off the bat, there's a lot of myths around credit. And so what are some of the myths that you try to dispel when you talk about credit?
Great question. So I could probably list off 50, but for sake of time, let's talk about the top couple of myths that I see out there. A lot of people think that they have a credit score. And so it's really important to know there are dozens and dozens of scoring models out there. So if you're applying for a credit card versus an auto loan versus a mortgage, they're going to be different types of credit inquiries, the way that it's pulled. So for a mortgage, for instance, which is my specialty, being a loan officer of 10 years now, we pull it from the space in which it's a little bit more risk-based from that viewpoint. So what's the probability of somebody paying back this mortgage on time? Basically, if you can show responsibility in paying the small things on time, you can show responsibility of paying the large things on time. That's the thought. So also, when you are pulling for a mortgage, that's the only time that all three credit bureaus are pulled at the same time. If you go shopping for an automobile, for instance, and you're getting financing, they only typically pull through one of the bureaus at a time. So another credit myth is people think that, well, gosh, I've had credit for 25 years. Well, you probably established credit 25 years ago with your first credit card or first, car loan or something, but your current credit profile is simply based on what is open and active now. So once you pay something off, it's no longer part of that algorithm that makes up your credit score. Another myth that I see a lot of people not really understanding is your payment history makes up 35% of your credit score. And what's really scary is if you've got a really exceptional credit score right now and you miss a payment, you're going to fall hard. So the higher you are in your score, the harder the hit can be to your credit score. So sometimes I'll see people say, well, it's just one payment. I've seen credit scores drop over 100 points because of one missed payment. So that's a pretty big misunderstanding as well.
Yeah, and I have said that to people before. They'll say, we're going to do a bankruptcy or we're going to do a debt settlement of a credit card debt or whatever, and they say, how will this impact my credit score? And I've always said to them, my understanding is the bigger the score, the bigger the drop. So somebody near 800 may be high 600. Where somebody in mid 600 may only drop to low 600 for the same event.
Exactly.
And I also always thought that it was, so one of the things you mentioned was length of credit and that they're only looking at stuff that's on there now. But I know one of the minor factors is length of credit. And so there's always been this concept of if I have a Visa card and I pay it off now and I close it now, that may negatively impact my credit because I'm taking away time from, my length of credit history isn't as long anymore. Even though it's current, the length is not as long anymore. Is that right, or am I off base?
No, so exactly. So I've seen people that have closed up credit cards that they had since college. Oh, well, I'm not really using this credit card anymore. It's got a crappy interest rate, doesn't give me any points. So I'm just going to go ahead and close that down. Don't close that down. You might get shut down just from inactivity. But so I would recommend using it every once in a while. Just pay it off a couple of days later so you're not having to pay that higher interest rate. One of the things that a lot of people don't really know, I don't know why it didn't make bigger headlines, but so during COVID, 70 million credit cards were either reduced in their limit available or shut down by the credit card companies. 70 million people. And that has a huge impact on your debt utilization ratio. So if you had a $10,000 limit and you had a $4,000 balance and they go, oh, we're going to go ahead and pull this down to $5,000. Now you're at 80%, which is as close as you can get to max without being max, right? And that calculation as opposed to, what would that be? 40% debt to income ratio. So it could really have a negative impact on your credit score. And if you were in the middle of applying for a mortgage loan or something like that, that could have really had some serious implications. Also, there are a lot of families that just simply don't have a cash emergency fund. Their emergency quote unquote fund is, well, if I have to put something on this credit card to get me through that emergency, that's what I'll do. And if that's your only credit card and this company goes and shuts you down, you don't have a plan B if you don't have cash money sitting in your bank account. So it's a really big deal. And that's why credit is really important. If you miss a payment, for instance, and your credit score goes down, all of your other creditors, they have the ability and the right, and they do, go and look at your credit. So it's essentially a soft pull. You may not even know that they've got that inquiry there, but they're looking to see what's going on with your credit profile. Are you becoming something of a risk? So I experienced this personally way back a long time ago, 2008. I unfortunately was a mortgage broker and my business ceased to exist, right? I couldn't get underwriters to approve mortgage loans with the financial crisis and the housing crisis. So during that time, I wound up having to short sale my home. And when I was told, hey, you have to miss 3 months of payments before we can even consider you for a short sale, as soon as I missed that first month's payment, Sean, and it hit my credit, all of a sudden, every credit card I had, boom, they reduced the limit to what my balance at that time was. I had a Capital One card that had a $30,000 limit, and they brought it all the way down to whatever my current balance was. So all of a sudden I had this I used to have this beautiful debt utilization factor, and now I've got this tiny little, maxed out credit card. It was devastating for my credit. So they're looking to see what's going on with your other creditors, because if you're not paying this payment over there, there's a potential that they won't get paid. So they want to hedge their risk, if you will.
Yeah, and the same thing happened to me. So one thing that I'm saying right now, and we could talk about a ton of stuff, and we could talk about mortgages and all that stuff. I will say real quick, when Hurricane Irma hit, I did a modification based on Hurricane Irma. I may have needed it, I may not have needed it, but I did it. And yeah, same thing with me. I got the modification from the bank, but I got letters from credit cards saying we're dropping your rates, or dropping your limits, because I had to miss payments to get on this Irma modification. And what I was going to say is, now with COVID and the shutdowns and all that other stuff, I have a feeling that all these banks that are doing forbearances and whatnot, they're going to have some kind of Irma analogous rapid loan mod, rapid something or other, because there's just going to be too many loans. It would go into default. If the bank says, okay, your forbearance is over, you've been in forbearance for 9 months, we need, with your next month's payment, we need 10 payments, and borrowers aren't going to be able to do that.
They won't be able to do that. So let's talk about that for just a minute. So you haven't made your mortgage payment in 3 months, 6 months, 9 months, because you've been part of this forbearance. Lender comes and says, hey, your term is up. Now you've got to have, let's say you were 9 months in forbearance, you've actually got to have 10 months worth of payments, because now your 10th month is due.
Right.
But you haven't been contributing towards your annual taxes and homeowners insurance. So most people, if you have a mortgage payment, will escrow towards the taxes and insurance, and you haven't been contributing to that this whole year. They're going to have to pay it on your behalf. And now you have a shortage in your escrow account. So now they're going to say, hey, you've got to pay us back. Not only do you owe us all this money, your payment moving forward is now going to increase to, repay them.
To cover the escrows.
It's going to be very interesting. And so while we're on this, before we move off of forbearance or deferment, just for those who may be considering it or are part of it, you actually have to make on-time payments for 3 months after the end of that term in order to potentially qualify for a new mortgage loan, whether it's a refinance or a purchase. So at the end of, let's say it's a deferment, which means they've just paused your requirement on the payment and they're putting it on the back end so you don't have to catch up all those payments. Then at the end of that term, you'd have to make 3 on-time monthly payments before you could apply for a new mortgage loan. And that hurts some people. Like, I've got a young lady that was moving from Jacksonville over here, and she was selling her house, but she was in a forbearance. And so because she's in that forbearance and she needed to essentially close on her home this next month, they won't accept 3 months in one payment.
Right.
It has to be spaced out for the 3 months. So it forces her, now that she's coming over here for a job, it's going to force her to be a renter.
Wow. And it's my understanding that under the CARES Act, they cannot report you as being delinquent if you haven't made payments and you're on a forbearance or deferment or some type of other plan. They can't report that to your credit under the CARES Act, but there is still the qualification, like you said, on the other end. When I'm going to refinance my house or buy a new house, I have to have made whatever it is, 3 payments or however many number of monthly payments. So even though it's not reporting on my credit and it's not necessarily dropping my credit score, I still have to do that in order to qualify for the new loan.
Yes.
Wow.
Exactly. Yeah. It's going to trip up some people at the end of this term.
Yeah.
Whatever that term is for them.
I've always said, and we worked, I don't remember when you came on as a short sale negotiator, but from 2008, 7, 8-ish until 2012, 13-ish was when we had the Great Recession. Most people will remember. I don't think we're going to get back to that level of short sales and defaults and foreclosures, but I think we're going to have more than what we've seen in a long time.
I agree with that statement. And this being one of those reasons, and then of course, unemployment and people being furloughed and those kinds of things would also be a contributing factor. But yeah, I think we're going to see, in my crystal ball here, I think we will see an influx of a potential influx of short sales and well, not even short sales and foreclosures. So let's think about that for a second, because a lot of people have equity.
Right.
So if you have equity, but you just can't catch up, it might force them to sell their home and go rent.
Yeah, I think there's going to be a lot of sales. Not as many short sales. Mm-hmm. There will be short sales. People will have, lost equity or been in their house for a while and have a very low margin of equity. Yes. So there still will be short sales, but I think there's going to be a lot more just selling the house, pulling the equity, using that to rent someplace, buy someplace, whatever.
Exactly. Yeah.
So let me bring us back to credit for a little bit. Yeah. So if someone has suffered a drop in their credit score, what are some things they can do to improve their scores?
So there's a whole lot of different plans, but the easiest, quickest way that I have found to improve your score after a drop is become an authorized user on somebody's credit card. So this is a great way to reestablish credit, to start credit, to kind of fix some damaged credit, because you've got something now reporting. So it doesn't start reporting from the day that it hits your credit. It actually starts reporting with a history from when that credit card had opened. So I have a whole episode with some more details. I'll just do it quickly here. And then if somebody wants to hear that, they could go to my podcast with that. So let's say your aunt has a Discover card that she's had for 20 years. There's a $10,000 limit. She only puts gas and groceries on it and pays it off in full every single month. That would be absolutely ideal. So you want a bank issued credit card, rich, deep, long history, high limit, low balance. The greatest part about this is that there's no inquiry because you're not responsible for that payment. Because you're not responsible for that payment, we don't have to use that in calculations for, say, a mortgage loan or something like that. But if you started a secured credit card or a new credit card today, what happens is it reports on your credit starting today, moving forward. You have an inquiry and it's a brand new trade line. You actually haven't proven your ability to manage that credit card. You haven't proven, you're not going to max it out. You've paid on time. Where with the authorized user account, you've got, that 20 years showing up. So I've seen where 20-year-olds get on their parents' credit card as an authorized user. You never have to even have a credit card in your hand, right? You don't ever even have to swipe it or use it. You're just borrowing their history. I've seen them get on their parents' authorized user card and have a credit score instantly. It's pretty significant.
Yeah, and I've recommended that strategy to a lot of people that go through a bankruptcy. So they hire me to file bankruptcy. And a couple things as we start to venture into bankruptcy world, that's one of the ways that I've told them, because when you file bankruptcy, one of the questions we get a lot is, well, I have a zero balance on this card. Do I have to put it in my bankruptcy? And I've always answered that two ways. Number one is that, the bankruptcy trustee wants to know everybody that you owe money to. They want to know what all your credit is. But the other thing is, like you said, some of the soft pulls. If I have a Discover card with a zero balance and they do a soft pull and they see that I filed bankruptcy, they may cancel the card anyway. So one of the ways that I've helped people to reestablish credit in that process is to make them an authorized user. Now, I like your idea of just borrow the history, but sometimes when someone's gone through a bankruptcy, they actually need to charge stuff on the card because they need to charge stuff on the card. So you got to be a little careful there. But one of the other things that I tell people, and so I'm curious to hear from you, one of the best ways, it won't happen quickly, but one of the best ways to rebuild credit after a bankruptcy, I think, is simply time. In other words, get a secured card and charge on that and pay it back up to, to the level, go buy gas and then pay it back, go buy groceries and then go pay it back. And then time. What I've always heard is that even though a Chapter 7 is going to be on your credit for 7 years, a Chapter 13 is going to be on your credit for 10 years, it'll only impact your credit 2 or 3 years for purposes. And that goes back to one of your first points about, different credit scores for different purposes. But what are some other things that you've seen or some other strategies you've recommended to increase your score or reestablish your score after, say, a bankruptcy or a foreclosure or a debt settlement or something like that?
Yeah. So, again, that credit report is just simply a snapshot in time. So if right now your snapshot in time is a pretty large derogatory event and it's recorded there under the public records portion of your credit report, it will sting for a while. So yes, to your point, a couple of years, 2 to 3 years, you'll start to see that the damage of that being reported and that experience being there kind of start to come off. So secured credit card would be awesome. I would encourage everybody to really get that you need to not have more than 30% as a balance against your limit. So if you start off with a secured credit card, a lot of times people only start off with a $300 or a $500 limit. Make sure you only keep 30% or less at any given time as a balance against that limit. The other thing is you could also go to a lot of community banks offer what's called a credit builder. And it's not even you taking out credit, but it is going to show up on your credit report as if it's an installment loan. So it's your own money and you can agree with the banker on what amount you'd like to end up with, how long of a term, and what your monthly payment is going to be. So let's say you say, okay, I'd like to do it over the next 3 years and I can contribute $50 a month. They're going to pull it out of this checking account that you have with them and then put it over here in this forced savings account over here, but report it to the credit reporting bureaus as a $50 a month installment payment. So at the end of that term, you actually have a forced savings account over there. So you're not taking on any new debt, but it is showing up as if it's an installment loan because you really want at least one installment loan and one revolving, which is a credit card, showing up to have a nice proper credit mix. If all you have is credit cards and you have no installment loan reporting, that could actually kind of hurt your score. About 10% of your credit score is made up of your credit mix or that balance of different types of accounts.
Okay. Well, it's good to know that at least I'm on the right track some of the time.
Yes. And if somebody is renting, you can pay a small fee to have that get reported on your credit report as an installment payment as well, your rent. There's a bunch of different companies out there. The one that comes to the top of my mind right now for this conversation, I'm not sponsoring them or anything like that, but it's Rentler, Rentler, Rentler.com is one that comes to mind. Some property managers do report it as well. And I know Experian Boost, I'm sure you've heard or seen those commercials. They will allow you to have your cell phone bill, electric bill, water bill, those kinds of things get reported as well. Now, it only hits that one bureau and not all three. However, if you could have a stellar credit score with that one, you're almost there.
Right. So you're saying that the tenant can report their own credit. They don't have to rely on the landlord.
Correct.
Wow.
Yeah, there's a small fee involved, but if you're looking to reestablish or start your credit, that would be an excellent way to not have to take on additional debt to have it reported on your credit.
So do you know how would the credit reporting agency verify that the information the tenant is giving is accurate? I mean, I could skip 2 months, pay late every month, but then if I tell the credit bureaus, yeah, here's my fee and I'm a fantastic tenant and I paid every rent payment on time, how do the credit bureaus verify that kind of stuff? Do you know?
Well, I'm going to take a stab in the dark because I don't do this myself. I'm a homeowner, not a renter. But I would imagine they would get a copy of your lease to see the terms, to make sure that what you are paying is what is required per the terms of your lease. And then I would imagine you'd have to show them that payment that has come out of your account, and then they would report it.
Okay. That makes sense.
Yeah.
Okay. So what about reestablishing, we talked about for someone that does. So for example, I got this question after a debt settlement case. So I had a client who owed money to a credit card and we settled it at a lump sum, and it shows on the credit as settled, or settled for less than the full amount due or something much
Yes.
similar to the way a
Settled for
short
less
sale.
than owed, yes.
Right. How would someone, is it all the same concepts in terms of, whether I had a debt settlement, whether I had a bankruptcy, whether I had a foreclosure, is it all the same strategies, or is there some strategy I should use after a bankruptcy different than a strategy I should use after a forbearance or a foreclosure or a debt settlement or something like that?
Yeah, not necessarily. I mean, I think they all kind of fall under the same. Again, we don't want to overutilize, credit. I know some spunky people will say, "Well, now I've got to reestablish. I'm going to go out and open up, 15 different store credit cards so I can prove to them I'm a good borrower of money." And that I don't believe is a good strategy. So I think that just, having at least one installment loan and at least one credit card, bank issued credit card as opposed to a store credit card, is really the best strategy. If you wind up with several, that's fine too. If you wind up with several, that's fine too. But going out and getting too many credit cards could actually hurt you. You would almost look like a credit risk. You could go out and max out every one of those on a shopping splurge this weekend and then, move off to some beaches in Belize or something and take off with all your goods, right? So right. You don't want to look like a credit risk. So too much credit is probably a negative, but on any side of any kind of a derogatory event of foreclosure or bankruptcy, short sale, anything like that, what you've got to do is be able to prove your ability to borrow money and pay it back on time. Most people wind up in a situation like this where, it's just simply something happened in your life, right? You got derailed from what the original plan was. And so you can make a course correction by, say, Chapter 7 and start all over. So now you've got to say, well, look, I've learned some lessons. Now I don't have all those store credit cards. Now I'm not counting on my bonus and overtime income for how I go and spend money. We become this payment society, right? Like I remember 20 years ago when Rooms to Go came out with, you can finance your couch and your bed. I was like, what? This is crazy, and just made it this really big national thing. And then now we can finance our cell phones, like there's not much that you don't have the ability to finance. Now there's these little microfinance companies, like Affirm is one that I see coming up on credit reports a lot now. You go into a shopping cart for an online store and it gives you the ability to have interest-free financing for this purchase of a couple $100. And where that's going to trip people up is you forgot that you did it here and you did it here and you did it there. And then so, in the next 30 days, you've got all these $25, $30, $40 payments coming at you. And you might be one paycheck away. Like if you got sick or if you got furloughed or something like that, if you're one paycheck away from not being able to pay those bills, what happens? I know a lot of people will spend the money from all of the overtime hours that they're working, presuming that they're going to always have overtime. Well, what happens if something shifts in your industry and now you're going back to that regular base pay? I see sometimes people will overextend themselves thinking that, what's happening now will just continue. But as you know, change is inevitable. Yeah.
When I was first learning how to use credit, that was one of the lessons I'll never forget from my father is if you don't have the money to buy it now, don't charge it.
Oh, such good advice.
Charge it and pay it down to zero every month. Now, unfortunately, I have kids, and so I got derailed from that. Pay it down, but my debt is under control. But still, it's and that's what I'm going to try to teach my kids. If you got the money in the bank, then charge it because you want a little bit of cash flow for a little bit of time, but don't buy it if you can't afford it, basically.
That's right. There's nothing wrong with leverage, right? We leverage for homes and for cars and for school, right? All these student loans, 45 million people walking around with student loan debt. And that's becoming its own worst enemy here. That's going to be the next influx of something.
Yeah, we'll see. Whoever's ultimately the president, we'll see what they do about it.
This will get interesting, and it's going to capture the attention of a whole lot of people too. So for sure, 45 million of them. There's nothing wrong with leveraging, right? But there is such thing as being overextended. So,
right. Right. Yeah. Leverage is not a bad thing as long as you don't live above your means.
Correct. Yeah.
So meanwhile, while we sort of get to the end here, I do want to let people know again, and I'll put it in the notes for everybody, but if you have questions for Kristi, it's really easy. Questions at creditkristi.com, and Kristi is spelled Kristi. Or you can, I encourage everyone to check out her podcast, which is Credit Coaching by Kristi. If you're listening to this episode. Wherever you're listening to this episode, you can find Credit Coaching by Kristi. And I understand you're going to use this as part of your show, so I'll give myself a shameless plug. If you're listening to this episode for the first time under Credit Coaching by Kristi, wherever you're listening to it, you can go find me at Crushing Debt Podcast. But before we sort of wrap up, is there anything that I missed? Is there anything that you want to add?
Yeah, I'd love to just focus for just a few moments about why credit is so important. A lot of people have never really learned the why behind it. You know that you've got a credit score and you know you've got a credit profile, but it's pulled for all different kinds of reasons. It's required for, well, good credit profile is required for financing of those really big things that you want in your life. So, your home, for instance.
House,
most people
car,
can't afford paying cash money for their house. And your credit score is actually the biggest impact on what your interest rate will be. And a lot of people think it might be about down payment or loan type or something like that, but it's your credit score that has the impact more than anything else. So whether you have 3% down or 20% down, that might be an eighth of an interest rate different. If you have a 620 credit score versus a 720 credit score, that could be well over a percentage point in your interest rate. And that will affect your cash flow. That will affect your buying abilities. If your payment needs to be this for you to be comfortable, it could really reduce the purchase price of your home, which means you're not getting as much bang for your buck.
Right.
Another thing that I think a lot of people don't realize, even your insurance, they pull credit for your insurance. So there are some auto and home insurance companies that will not offer you protection through their insurance if your credit score is too low. I know a lot of property managers that will not rent to people that have under a 600 credit score. So, it can stand in the way of a whole lot of things. So not only can it cost you tens of thousands of dollars more over your lifetime in unnecessarily higher finance charges, but it can also keep you even from renting a house or having, affordable auto insurance. So a credit profile is simply a snapshot in time of your ability to borrow money and pay it back on time. And so if we make it more complicated than that, right, it doesn't have to be.
One of the other important things about a credit score, again, in my world too, is that people can't discriminate against you because you're a woman or I'm a man, and they can't discriminate based on, whether you're straight or gay or black or white or, whatever. There's all the protected classes is what we call it in the law, that people cannot discriminate against when they're looking at you for housing, looking at you for a job, looking at you, for whatever basis. But they can discriminate based on credit score. Credit score is not a protected class. So if you have an employer that's looking at somebody with a 620 score and a 720 score, they can say we're taking the person with the 720 score because it's the better score.
Isn't that incredible?
Yeah.
That 620 credit score might appear to an employer on that point that you have some financial stress.
Right.
If you have financial stress, you might bring that into the workplace and not be as a productive employee. So it's an interesting take there, Sean.
I actually had, back at the old law firm, had somebody that we were representing who's in the military. And he said, I can't file bankruptcy because that'll drop my credit score. And we had that discussion. And I said, well, why is it so important to the military? And he said, because this is what he heard. And I've never been able to verify this by any other source. But what he said was other foreign powers may have access to our credit scores. And if they see a military, especially a higher ranked military personnel or somebody in charge of some kind of secrets or classified information, and they know that your credit score is low and you're having money problems, that could be who they target to pay off to get access to that kind of stuff.
Whoa.
So again, this is what this one person said. I've never independently verified it. Sounds
That's
like
heavy.
It sounds like it could be correct, but I have no idea. But so thank you. I appreciate you reaching out. I appreciate reconnecting with you and before we recorded this episode, talking about some of the old times, and I'm sure we can tell some more stories off the record, once I click the stop button as well. Thank you for being a guest on the show. I appreciate it.
Yeah, this is awesome, Sean. Thanks so much. I appreciate your time.
So I will wrap up this week's episode of the podcast. Like I say at the end of every episode, I hope that at the end of the month you have more money rather than at the end of the money you have more month. I probably could incorporate credit into that statement somehow. I'll figure it out later. But that'll do it for this week's episode. We appreciate you listening, and I will catch you in next week's episode of the Crushing Debt Podcast.
If you have questions that you think would make a great topic for a future episode, please email Sean or connect with us on social media. Sean Yesner and Yesner Law, PL, are Florida licensed attorneys. The information contained in this week's episode is not a substitute for legal advice. Your situation may differ, especially if you are located somewhere other than the state of Florida. If you have questions, please contact our office or contact a local attorney. Thank you for listening to this week's episode of the Crushing Debt Podcast.